Welcome to The Explainer. Today, we're tackling a pro trading strategy that has honestly a super misleading name. It's called the bear call ladder. But, and this is the important part, it's not what you think.
All right, so let's get right into this paradox. You see, the bear call ladder is basically a souped-up version of a more common strategy, the call ratio backspread. But what makes it so special? Well, it fixes the single most painful, gut-wrenching flaw of that older strategy, that nasty, potentially huge loss zone that can pop up right in the middle of your trade.
Okay, first things first, let's solve this mystery. Why on earth would a strategy built for a rising market be called a bear call ladder? Well, the name itself comes from some technical jargon, some conventions and how these things are built, but don't let that fool you. Its purpose is 100% bullish.
So, at its heart, the bear call ladder is all about capitalizing on a big, strong move to the upside. You can really think of it as a much smarter, more refined version of the call ratio backspread. It takes all the best parts, like getting paid a credit just to open the trade and having that sweet, unlimited profit potential, but then it does something brilliant. It completely re-engineers the risk to make it way, way more manageable.
So let's look under the hood and see exactly how this three-legged structure makes it such an elegant and powerful tool. The real magic here is in adding just one extra piece to the puzzle.
Okay, so if you look at the standard call ratio backspread, that's the one on the left, it's a two-legged strategy. Simpler, for sure, but here's the problem. It creates this really painful zone where even a small move against you can cause a pretty big loss. Now look at the bear call ladder on the right. It adds a third leg. Yeah, it's a little more complex to set up, but that one extra leg is the game changer. It's what transforms that awful middle loss zone into something much, much smaller and totally controlled.
Now let's talk about the economics, because this is where it gets really interesting. With the bear call ladder, you actually get a bigger credit up front. In our example, that's 60 rupees versus just 45 for the other spread. But here's the kicker, and this is the best part. Your maximum potential loss is also lower. We're talking 140 rupees versus 155. Think about that for a second. You are literally getting paid more to take on less risk. I mean, that's a combination you don't see every day. So how does this thing actually work? Well, it's a simple one-to-one-to-one structure. First, you sell one in-the-money call. That's a call option that's already in a profitable position, and selling it gives you immediate income, a credit. Then you take that cash and you buy two other calls, one that's at the money, right near the current price, and another one that's out of the money, which is cheaper. These two calls that you're buying, they're your hedge and your profit engine, all rolled into one. They work together to keep the risk in check while setting you up to capture a massive move to the upside.
And that right there is why the pros prefer this strategy. The economics are just flat out better from the get-go. I mean, think about the psychology of it. When you get a bigger credit and you know your max loss is smaller, it just feels better to trade. It helps you stay rational and make clear-headed decisions when the market gets choppy.
Okay, so we've seen how it's built. Now let's look at how it actually performs when the options expire. The best way to think about it is to break the possible outcomes down into three very distinct zones.
So, Zone 1. And this is frankly the beautiful part of the strategy. Let's say your bullish prediction is completely wrong. The market goes sideways or even tanks. You still win. You walk away with a profit. How? You just get to keep that initial 60 rupee credit you collected when you opened the position. Not bad for being wrong, right?
All right, now for Zone 2. This is what you could call the danger zone. It's the trade-off. If the price just kind of drifts up a little bit and lands in this middle range, you do take a loss. But, and this is absolutely crucial, that loss is capped. It is a known, defined risk. In this case, 140 rupees. That's it. It's still a loss, but it's smaller and a whole lot less stressful than what you'd be looking at with that older two-legged version.
And then there's Zone 3. This is what it's all about. This is where the strategy truly shines. If you are right and the market doesn't just go up, but it soars, once it breaks past that upper break-even point, your profit potential is completely, totally unlimited. The higher the price goes, the more money you make. Simple as that.
So this table here really lays it all out perfectly. You've got your three scenarios. Below 7,660, you pocket that initial profit. Nice. Between 7,660 and 8,040, that's your max loss zone. But remember, it's defined and controlled. And then if the stock just rockets past 8,040, boom, you're in the unlimited profit zone. It's a very, very clear three-act play.
Okay, I have to be really clear about this. This is not an everyday run-of-the-mill strategy. It absolutely requires precision. So let's talk about the playbook.
What are the specific conditions that the pros are looking for before they even think about putting on a trade like this?
You really need to be able to check every single one of these boxes, no exceptions. First, you need a strong, high-conviction bullish view. This isn't for maybes. Second, there has to be a clear catalyst on the horizon. We're talking earnings, a big announcement, something that can really move the market. Third, you're not looking for a slow drift up. You need to be expecting a large, decisive breakout move. And finally, you got to give it time to work. You want at least 10 days, preferably more, until the options expire.
Timing is also a huge factor here. You generally want to put this trade on early in the options cycle. Now, why is that? Well, it's all about volatility. If uncertainty in the market starts to pick up, it actually helps your position. It acts like a tailwind. See, the two options you bought gain value from rising volatility much faster than the one you sold loses value. It gives you this extra little boost. But that benefit really starts to fade away the closer you get to expiration day.
All right, we've covered a lot of ground. So after breaking all this down, what's the one key takeaway? What's the single most important thing you need to remember about the bear call ladder?
Here it is. You need to think of this strategy as a sniper rifle, not a machine gun. It is a precision tool. It's something you keep in your arsenal for those very specific, high-probability moments when you're expecting a massive move driven by a clear catalyst. This is absolutely not for everyday trading or for just taking a random guess.
So that leaves us with one final thought. The next time you have what you think is a big trading idea, ask yourself this question. Is this just a hunch, or is it a high-conviction, catalyst-driven thesis? Because only one of those is precise enough for a strategy this powerful. And you know what? Understanding that difference, well, that's what separates the pros from everyone else.